Hey, Dan Passarelli here. Well, we had the CPI numbers come out this morning, and good news, I guess. The inflation rate was lower than expected. The core CPI, which is the important one, it excludes food and energy, which is much more volatile than most other sectors. The core CPI came in at 0.2% versus an expected 0.3%. So that means that there is less inflation than was expected to be. Now, a couple things. When that number came out, I saw a flurry of headlines saying that the market or traders are changing their expectations for the Fed. Okay, what does that even mean? I forget what news source that said. The Fed they make up their own minds. They have their expectations. Traders can't change the Fed's expectations, right? And so and who are these traders? That's a very broad and general statement, but it was enough to rally the market, right? S&P 500 up, here's last 8 minutes of the day here, last 7 minutes of the day, 0.7%, and it was up a fair amount higher earlier. So the traders that I would say matter are the ones who are trading the Fed funds rate contract on the CME group, and they are pricing in a 92.4% chance of the Fed raising interest rates by 25 basis points at their next meeting, which is on July 26th. Only a 7.6% chance of having those rates remain unchanged. So this was a little bit of a microcosm, I think, of what Alan Greenspan referred to as, what did he call it? Irrational exuberance. We won't go that far, but we'll call it maybe a little overzealousness, because whatever this journalist said that traders are changing the Fed's expectations or whatever, doesn't really seem to have changed anything. And the Fed at this point, I believe, is very, very likely to stay its course. I hope that helps. This is Dan Passarelli, Trade Smart.